Welcome back. Well, SEBI has proposed a major overhaul of India's mutual fund fee structure to simplify charges, boost transparency and reduce investor costs. SEBI, in a consultation paper, has proposed to lower the expense ratio charged by mutual funds, and Jefferies believes that a 5 basis points cut in equity exit load related charge can impact AMC profits by 8 to 10% if implemented in FY27. To understand the impact of the proposed norms, we are now joined by Akhil Chaturvedi, who is the Chief Business Officer and ED at Motilal Oswal AMC, and Shweta Rajani, who is the Associate Director and Head of Mutual Funds, Anand Rathi Wealth. Shweta and Akhil, good morning. Thank you so much for joining in. Shweta, let me start with you first up. How significant is this move if the proposal actually goes through? We are talking about a cut in that 5 basis points fee that is charged, but at the same time, the base level charges, they have been raised. So will it be neutral for AMCs and investors, or is it largely in favor of investors?
Good morning, Sonal. So firstly, I have to say, the overall circular, if I look at it from a client standpoint, it's very good. And, over the years, we've seen SEBI has been focusing towards investor protection, investors' benefit, bringing in transparency in mutual funds, having more disclosures. And this is one welcome step, towards that again. Specifically talking about the 5 bips exit load, see earlier on, also, if you see this till 2018, this used to be 20 bips of exit load oriented fees charged, which was brought down to 5 bips. And this was any which way is supposed to be transitionary in nature. This 5 bips actually goes back into the scheme. It doesn't go into the AMC profits any which way. So from an AMC profitability standpoint, I don't think it's going to have any implication. From a expense ratio standpoint to the investor, this is again a good thing because it will reduce the expense to that impact. Because earlier on, what would happen is if the base TER was, let's say, around 1.8, and then you had this additional 5 bips. Now, while there has been a reduction on the total base TER as well, this 5 bips is now included as a part of that TER. So it brings down the expense for the scheme for the investor. So for an investor, this is good because it will mean marginal improvement in the NAVs and the return that you would see. As far as an AMC is concerned, this used to anyways get passed on to the scheme, not to the AMC profitability, so should not have an implication there.
Oh, okay, all right. So it should not be that big an impact on the AMC because it was passed on to the scheme. Akhil, what's your take and how do you view these proposed changes?
So I agree with Shweta that largely the regulator is keen to ensure that as the industry scales up and reaches newer milestones, there are economies to scale, and and such economies of scale, probably should be passed back to the investors. So cost coming down in any way is always positive for the investors because the leakage of return actually drops down. Now, broadly what we see is there are two large changes from investors' perspective. The larger change, what we see is obviously the cost of trades, where we were paying up to 12 basis point as brokerage. This comes down to 2 basis points. So that's a straight shot 10 basis point benefit back to the investors. So that's a significant, I think, development, point number one. From the AMC perspective, like Shweta mentioned, 5 basis point, which was being charged in lieu of the exit loads, now goes away. Right, and they're saying that they've included that in the first two slabs. But having said so, the base TERs have come down by 15 basis points. The only flip is that the statutory charges like GST, STT, all of these charges will be now loaded on the total TER and will be then eventually passed on to the investors, right? So, net, I feel that there is a marginal impact on asset management companies and distribution, but a big benefit coming to investors by way of operating costs coming down via reduction of cost on the trades.
Okay. Will this new framework meaningfully reduce the cost gap that we see between active and passive funds? Shweta, let me start with you first on this.
Yes. See, let me talk about a passive fund today. If you're investing in an index fund, most of them have, while they're allowed, I think, 1%, they generally would charge somewhere around 50, 60 odd paisa as the base TER and little add on to that. So even in the passive fund space, there's been a 15 paisa reduction now to that 1%. It's come down to 0.85. So to that extent, it's a 15 bips reduction. But your brokerage and all those costs included, if I look at even the active space now, clearly between the two fund structures, active and passive, in the active side, if you put everything together, the reduction in the TER, the exit loads going away, the brokerage costs coming down could mean somewhere around a 20 bips of reduction across the slabs on the expenses. So would it bridge the gap between the returns that you see? Definitely. The cost reduction would mean that your active fund is seeing little more reduction in your expenses. To that extent, the return differential between a passive and the active fund would go up. The costs would come down between the two. The cost gap would come down, I would say maybe around 10 paisa. And to that extent, the performance of the active funds would further go up.
Okay, and that continues to be the debate always, active versus passive. How do they perform in a market like this? So you are saying the cost would go down and active funds would perform better in that case because of the cost differential that would come by. That's an important clarification. Akhil, the other part of this notice has been that this performance-linked TER framework, which the AMCs can or cannot adopt. The other one is separated execution from research cost. Both of these, will that be a challenge for AMCs, or do you think this is a welcome move?
So on the first part, obviously, I think it's a welcome move. Since we also run a large alternate book, and we see that a lot of the high net worth family offices, they prefer to have lower fixed expenses, and a lot of the performance fees needs to be paid once the manager performs. And that kind of a structure, if it can be implemented on the mutual fund structure, so definitely from HNI's perspective, I think it's a welcome move. Now, how and in what format it will happen, obviously it needs to be seen, and we'll wait for a lot more clarity. But if there can be a separate, like in alternates, we have separate share class. Here, if we can have a separate performance plan, and what kind of flexibility is given in terms of hurdle rates, the carry share, etc. But clearly there is an audience in the market who's looking at rewarding the fund managers basis their performance, and will have one more option to choose from between a fixed fees or a variable fees basis the performance. So I think definitely it's a welcome move.
Okay. Okay, all right. We have a lot more questions, but we are lacking time. So I think we'll take this forward on another show. But thank you so much for joining us today, Shweta and Akhil, and making sense of these moves. Of course, these are just proposals as yet. There's no finality. The last date for comments is 17th of November. So we'll get more updates on that by then. But it's time for a short break now. We'll get you more on the markets on the other side of this very short break. Stay tuned.